You might have heard of the film The Big Short. It's all about the 2008 financial crisis. Specifically, one savvy investor, Michael Burry, played in the film by Christian Bale, who was able to short the housing market to make millions of dollars, while everyone else panicked and the economy crashed and burned.
I want to buy swaps on mortgage bonds that will pay off if the underlying bond fails.
You want to bet against the housing market and you're worried we won't pay you.
Yes, that's correct.
But when we say he shorted the market, what do we actually mean? And is this something regular investors can do as well? First, let's start with normal investing. Usually you buy a stock hoping the price goes up. You're aiming to buy low, sell high and make a profit. This is called value investing, buying underpriced stocks valued at less than what you think they're worth, so that you can profit when the stock price rises and catches up to its true value. But shorting flips that around. You actually make money when a stock goes down. Here's how it works. Imagine there's a company called the Cheeseburger Company. Their stock price is $50 a share, but you think the stock price of the Cheeseburger Company is going to tank. It's overpriced, their burgers taste weird, whatever it is. So you decide to borrow 10 shares of the Cheeseburger Company from a stockbroker. You then sell those shares immediately at their current price, which is $50 per share. So, you just got $500 from selling shares you don't even own. Weird, right? You then wait for the stock price to drop. Let's say the Cheeseburger Company falls to $30 per share. Now, you buy back the 10 shares, called covering, for $300. You then return the borrowed shares to your broker. You started with $500, spent $300 to buy the shares back, and boom, you made $200 profit, all because the stock went down. Sounds easy, right? Well, here's the catch. Shorting is very risky. If the Cheeseburger Company stock goes up instead of down, you lose money. Let's say it jumps to $70 per share. Now, buying back 10 shares would cost you $700, meaning you would lose $200. There's basically no limit to how much you can lose, because stocks can theoretically go up forever.
Dr. Berry, we could work out a pay-as-we-go structure that would pay out if the bonds fail, but it would also apply to your payments if the value of the mortgage bond goes up. You'd have to pay us monthly premiums.
Is that acceptable, Dr. Berry?
Yes.
A stock can only fall to zero, but it can rise forever. That means losses are technically unlimited. That's why Michael Burry's 2008 short of the housing market was such a risky move. Shorting requires something called a margin account. That means you must deposit extra money. The broker can demand more money if things go wrong. When the broker demands more money, this is called a margin call. It's the broker trying to protect themselves from risk. If the stock price rises too much, the broker can automatically close your short position to stop further losses. They protect themselves first. So, how are stockbrokers able to lend out stocks? If you have what's known as a margin account, this means the broker is allowed to lend out your shares. Look in the fine print of the agreement and you'll see this written there. If you have what's known as a cash account, it means brokers generally cannot lend your shares without extra permission. Many brokers also offer voluntary stock lending programs. If you opt in, your shares can be lent to short sellers. So, why would somebody want to lend out their shares? Because they get paid. When shares are lent out, the borrower pays interest, called the borrow fee. The original owner may earn a small percentage. So we've seen that shorting is a risky game, but there is a way investors can practice it safely. You can invest in what's known as an inverse ETF. This is a fund designed to go up when a market goes down. Instead of shorting stocks yourself, which would involve borrowing shares with potentially unlimited losses, You can just buy one of those ETFs and it rises when the market falls. It's like a reverse gear for investing. It's important to remember that inverse ETFs are for short-term trading, not for long-term holds. This is because they reset daily. Imagine you're trying to walk up an escalator that's going downwards, faster than you're able to walk up. Even though you're stepping up gradually, you're still drifting down. That's what inverse ETFs are like over the long term. But there is an even simpler way to profit from markets falling that doesn't require shorting or inverse ETFs. It's the age-old strategy of selling when you think the market is overvalued and then buying back after the crash when the stock prices are cheap. Here's a graph showing the history of stock market crashes. We can see that market crashes happen over and over again. Ideally, as investors, we want to use these crashes to buy up stocks while they're cheap and then sell them near the top of the peak to make a profit. But predicting market movements isn't easy. Knowing when to act often takes careful research and insights from experienced investors. Lots of investors are saying we're on the cusp of a big market crash right now. Watch this video to the right to learn all about the AI bubble we're currently in. Thanks for watching. See you on the next one.